Right, we are live. Oh, and there he is. Wow, like magic. I start the show and Doug shows up.
That's how it goes.
All right, well, we're live, man. So no time
I
to.
know.
Doug is.
Yeah, no time to gab. Evidently, there's multiple restream links, and but we're here. So good
That's all
morning.
right. I was worried that the aliens or the men in the black boots with the helicopters, black helicopters, got you, but apparently not. Not today. Tomorrow maybe, but not today.
Yeah,
All right.
exactly.
All right. Well, let's get this party started here. Now that we got Doug, now it's a party. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name's Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend Doug Hagerin. Hey, Doug.
Hey, Kirk. Good morning. You feeling okay? You sound your
Uh,
voice a little off today.
it's a little off. I know I usually have that little deep voice, that voice of midnight jazz that I usually do, but today it's extra jazzy because I was sick most of the weekend. I went
Ah,
to Florida on a vacation 2 weeks ago, and when I came home, apparently there was some sick people that decided to cough all over my seat, and a week later I got sick. So that's my fault for going on vacation with in an airplane full of sick people. I feel like every time I go on a trip, I come back sick because I touched something that somebody else was coughing all over. Anyway, nonetheless, it's allergy season for me. So even if I wasn't sick, I'd probably still sound like this. All right, let's get started. We got a full plate today. I want to talk about a bunch of stuff. This week, we have Jay Powell with the FOMC meeting coming out, and the market is waited on bated breath for what he's got to say. And you know what? I could give two you know what's. I think we all are accustomed to living on the words of the bated breath of the chairman, of Jay Powell, and frankly, it doesn't really matter because the market's going to do what it's going to do. At the end of last year, the market thought that they were going to cut the rates by some standards by 7 times. And here we are, almost in May, and certainly not 7 times. It's been zero. And that's been my guess. Zero, maybe one time, but my guess is I still give it a 70% chance of zero rate cuts this year. And you know what? The market has finally started to agree with me a little bit more. We had, I'm going to share a quick chart here, and then I'm going to go into a different segment, which I think was pretty interesting to me. So here's a chart which shows the number of rate cuts this year. And this is Kalashi, which is basically a betting site for the markets for different metrics that you don't typically have a standard for. Usually in the markets, you can bet on virtually anything, but some things like number of rate cuts or things like that, you generally can't. But in this site, you can. I'm not suggesting you go to this site and gamble, but it's really good for data. And that's why I use it. I use it for data because I look at this and say, all right, what is the quote unquote market of betting participants betting against? It's kind of like looking at sports betting and saying, all right, what do the odds makers say? Does that mean that you should go bet? No, but it means that, well, this team has a X probability of winning. And that's how I use it, as more of a data gathering metric. So if you look at January, it looks like they're going to have 5 or 6 rate cuts. That was the prediction. Now it's closer to one. So forecast is one rate cut this year, which I'm not saying that I predicted it, although I seem to have at this point. It's still early in the year. We're 4 months in, and we've got a long way to go. So I'm not making any claims that I'm right yet. We still have quite a long way. But I would argue that by August, that's all baked in because they're not going to be cutting rates going into election season unless there's a crash. I think if they did that, I think a lot of people would be mad. Although I don't know, no one seems to care this anymore about politics. So let's move back to reality here, since no one cares about that. And I meant politics, not the markets. So let's talk about let's talk about the hot mess. Doug, you want to talk about the hot mess? You're the one that sent me this. We're basically let me see. Where's the hot mess here? So we're talking about this was actually almost a week and a half ago, where excuse me, where where basically inflation was higher than expected and GDP was lower than expected. You want to talk about that a little bit? Or you want me to go at it?
No, I'll talk about it. I was just waiting for you to pull it
Okay.
pull it up. So And going back to what you said before, I think it's really interesting that there is still an expectation, given what I'm about to talk about, that there's actually going to be a rate cut this year. But basically, what we are effectively dealing with now is we came in roughly, and I'm trying to remember exactly, the actual details of it from where it was, but effectively we came in roughly. GDP, here it was, first Q1 2024, GDP growth slowed to just 1.6%, which is less than half of the 3.4% Q4 2023 number. Okay, not less than half of what it was just a quarter ago. Okay, what that means is that we have completely and utterly stalled on the GDP on the economy. But the thing is that doesn't stand alone, because ultimately the U.S. core PCE price index has actually jumped to just about 3.7. Okay, so if you look at and this is the GDP personal consumption core price index. So, but in other words, basically what has happened now is there is almost a 2-point spread between what is going on with GDP and what is now going on with inflation. What does that mean, folks? Welcome to something, I don't know, we might have talked about this in the past, or so it came from somewhere, something for the known as stagflation. In other words, we don't have hyperinflation because of hyper growth in the economies. We have hyperinflation completely independent of what is going on in the economy. In other words, it's slowing down, but it's increasingly expensive. And this is an extremely dangerous place to be, because if GDP slows down, which means economic activity is slowing down, it means that ultimately there is potential. Now, this could be a blip. I don't know. Next quarter, second quarter could be wonderful, right? We've had sometimes things come out where just basically a lull after other economic activity, weird data comes in. But if this is something that tends to become a pattern here, you're running into a situation where this will trickle down into what is being felt by a greater number of both personal and consumer victims. Okay. And that is a rippling effect, because effectively, if businesses are going to start making decisions, if they are not able to produce as much, if the results of their activity are starting to be in a position where they're not seeing the returns on that, that can trickle into things like labor and employment. It's been a hot labor market. Nobody could get enough employees. Well, right now, for both businesses and consumer, everything's more expensive. Okay. So if everything's more expensive and the economic activity is not there, people are relying increasingly, and we've talked about rising credit card debt and other types of consumption. I just saw a data that came out, I haven't been able to post it yet, that 56% of businesses were unable to pay rent last month. Okay. Now, what that means is, they're falling behind. Now, a lot of this was the restaurant industry, which has just been slammed by increasing food and labor costs and still reeling from, post-COVID issues. But effectively, everything's more expensive. And now what could happen if things slow down is that could increase the probability of a reversal in the job market. And if there's a reversal in the job market, everything that's being paid for under that new expense is now something that you run into a situation where you start to have unemployment. And if you have those two things together, it's it's basically the stone that has gone over the cliff, increasing speed. But this is what we talked about. We said it felt very much like the 70s, but there's some things that just weren't clicking. According to this data, it has finally clicked. What's really concerning to me about the fact that this was a first quarter GDP metric is that's post holidays. And the holidays have typically been one of the greatest GDP producing time periods of the year, because it's when people go out and spend money for Christmas and other types of events. So that's why there's a lot of engagement of what's happening on Black Friday, what's happening with, holiday sales. So if GDP crawled that much a quarter later, again, I don't have a crystal ball, but to me, that's extremely ominous about where we're sitting right now and what may be to come.
Yeah, I think that the comment about stagflation is, I think, is really important because um, if you look at history, most of us have forgotten the 70s, which is really what happened. Now, I do want to point out two things. First, Doug mentioned hyperinflation. We don't have hyperinflation; we have higher inflation. I'm just correcting him
If I
because
said hyper, I apologize. Yeah,
yeah. No,
that was a
I
mistake.
mentioned it because I think the word hyperinflation gets thrown around a lot. And I know Doug misspoke, but it gets thrown around a lot. And what I think people need to realize is the definition of hyperinflation is going up 50% a month. Okay, that is anomalous. It is not normal. Zimbabwe had hyperinflation. Weimar Germany, a bunch of places have had hyperinflation before. I mean, you could have 20%, 30% a year. That's still not hyperinflation. That's high inflation. It's really high, but it's not hyper. And hyperinflation is effectively when a country no longer trusts the currency. Now, I want to be clear. When the currency is no longer trustworthy, when people don't want to hold it, that is when hyperinflation starts to take off. Now, you might say, well, I don't trust the government. Okay, you're one out of 300 and what is it, 50 million people in the US. You don't matter. Now, when 200 million people don't trust it, that matters, right? Because effectively people stop treating it as an asset and they start treating it as something to get rid of quickly, which is why it loses value because people don't want it. They're like, oh, I'm going to pay you in dollars. No, don't pay me in dollars. Pay me in something else. Pay me in gold. Pay me in Bitcoin, whatever it is. Like, but nobody wants to hold the dollars. That is when we have hyperinflation. We're a long way from that. Okay. And by the way, if the US has hyperinflation, it means the whole world has it because the US is the global reserve currency. And at our current status as the global reserve currency, technically, I'm not sure if we could have hyperinflation, but the whole world would have it, which means that all else balances out. So we have other problems if that happens, okay? And the hyperinflation is the least of your problems, I think, at that point. So, what might we get there? Yes, we might get there at some point. Are we close to it? Absolutely not. So don't worry about it. So all the people out there who are worried about hyperinflation, worry about invest in gold because the dollar's going to zero. Yeah, it might go to zero, but it's not going to happen overnight, and it's not going to be today. So, put away your tinfoil hats. I know I have one over here. I haven't put it on in a while for the show, but put away your tinfoil hats. There will be a time, and I'm not saying you shouldn't prepare. Right? Like we own gold too. We love gold. We've loved gold for years. It doesn't mean I have 100% of my assets in gold because I'm afraid of the dollar going to zero tomorrow. That's just, and I don't want to, I'm going to offend people here. That's crazy talk, right? When somebody claims that you should put all your money in gold, that's crazy talk, and they're trying to take advantage of you. All right, so you should kind of say, isn't that interesting when somebody says that? Now, is gold a good idea? Absolutely, it is. You should never put 100% of your money into anything. That's just good rule of thumb for investing. Now, if it's your own company, okay, you can make that argument. I get it. If you're an entrepreneur, you're putting all your money into your own company. I get it, right? I'm not saying you should, but I understand. But most smart people, even if they're really wealthy, here's the rule of thumb. You make all your money in one company and and that's how you make your money, but you diversify to keep it. All the wealthy use this rule of thumb. So if you've made bazillion dollars by selling your company, or you own it, like you're Elon Musk and you still own a bunch of companies and you're one of the wealthiest, if not the wealthiest man on the planet. Okay. I guess he probably isn't now. Tesla's not doing as well. But anyway, if you're a guy like that, you made all your money in one or a few companies. In his case, he's a rarity. Most people make it in one. Make all your money in one company. But the smart people, once you're no longer with that company and you're no longer driving the ship, you diversify. So like his heirs, for instance, probably aren't as smart as Elon. So the smart move would be to diversify into multiple assets so that you keep it. That's the point. So you should use that rule of thumb yourself, right? You make your money and you diversify to keep it, right? And I'm not suggesting you grow your money in one company, okay? I don't want you to take this analogy too far. If you're saying, well, I should put all my money in some tech company and it's going to go to the moon or put it all in Bitcoin, that's how I'm going to make my money. That would be extremely risky and potentially really stupid. because you could also lose it all, which is the other side of the coin. Yes, you could make a lot and you could also lose a lot. If you're that kind of person who wants to go to the casino and put it all in black or red or whatever, have at it. I'm not I'm not advising you to do that. I'm advising you against it, just to be clear. But anyway, so getting back to some things I want to talk about today. I want to talk about this. There's a few different frameworks here, and then I want to get into housing. We haven't talked about housing in a while, and Doug's going to love this. So I found a great PDF on housing, and I'm going to talk about it. And I'm also going to. We won't have time. We'll probably do the JP Morgan report next week, which is always a big quarterly report to look at. Here's something I want to talk about, though, and I wish. Here we go. All right. So I haven't seen anyone talk about this in a while, and it came up, and I love it because this is something that I don't talk about enough. The inverted yield curve. Okay. Now, when this first started a few years ago, we talked about it. People said, "Oh, inverted yield curve. We're going to have a recession in the next 12 to 24 months," I think is what they said. Because historically, that's kind of what's happened. Okay, here's the problem with that. Here's another lesson: correlation versus causation. Okay, this is a correlation, and I think it's like 10 out of 10 of the last recessions, 10 out of 10 times, or I don't know, 7 or 10, whatever it was. It's 100% of the time that we've had an inverted yield curve had led to recession shortly thereafter within like 12 to 24 months. I think that's the stat. Now, what they said is when it happens within 12 to 24 months, a recession happens. Now, I've tried to deconstruct why it happens. And in the past, decades ago, I could say, okay, I get it. The banks stop making money. They stop lending, which slows down the economy, which slows down the printing of money, which slows down the economy. Now, in the past, that was probably true because the Fed wasn't out there printing money like a drunken sailor like they are now and have been for the last 20 years. However, now that causation, quote unquote causation, which is my hypothesis, is potentially broken because they're printing money and the banks haven't been lending for a while. It's been kind of a mess in the banking sector, so the banks don't need to lend because the Fed just prints money. So I don't know if that still works. Now, if you look back, what you'll notice is that we go into recession every single time after the inverted yield comes back to normal. It's always after it comes back. We're still inverted. And it's been inverted for 2 years now. So, the fact that we haven't hit a recession like most people predicted, it doesn't mean that it's not coming. It means that we haven't gone back to neutral or even positive yield curve yet. Now, that could lead to recession afterwards. I don't know. And I don't know if this correlation is going to continue to hold up either, because the Fed printing so much money has broken the financial system. It means that all the factors that used to work stopped working. They're not working anymore because, like printing money just screws everything up. We no longer have a free market. And for those of you who think we do, you're kidding yourself. We don't have a free market anymore. And that's been true for a long time. We have shades of a free market, but it's not a free market, not by a long shot. Anyway, I just wanted to say that. I'm going to dip into the housing market because I think the housing market's still very interesting to me, and I'm going to bring up some charts. So give me a second here. I'm going to bring up the housing charts because there's a ton of them here, which are, like I said, very interesting to me. All right, here we go. Why is this taking so long? Okay, here we go. Doug, you want to talk about some of this? Because there's some interesting ones here.
Sure. I haven't looked through this though.
Okay.
So if you have, I'm going to let you drive it. Yep.
All right. Let me start, and you can pull out some you want to talk about.
Okay.
All right. So here's what I want to talk about here. So this is a report done by, it looks like Resi Club. I'm not sure who they are. But I got this report sent to me by somebody who studies this stuff in depth and thought it was good. So I figured I would share it because some of the statistics here just kind of shade some color into the housing market. So here's a chart here of the share of remote workers. Okay, it shows 2019 pre-COVID, 2021, 22, and it just shows a trend. Now, the real estate market is local. Right. So we talk about the real estate market like it's one thing, but it's really not. It's many, many, many different smaller things. all aggregated into, if you could put it into an index, that's fine, but it's not really accurate. You need to look at the regional part of the real estate market. So here we go. So we look at a place like Austin, Round Rock, Texas, Georgetown, that area. It went from 10% was the highest share of remote workers, 2019. Then it went up to 32% in 2021. Now it's down to 28, which is still, I think, the highest metric. So, you look at places like San Francisco, went up to 35%. That was the highest in 2021, started at 7. Now it's at 27. Boston started at 5, went to 26. Now it's down to 20. It's just interesting to see these charts. So those of you who are listening, just go to the website or go to YouTube and you'll be able to see the chart as well. But I find it really fascinating because if you want to see trends, right? If you want to see where people are moving, this is an important place to see. Here, people are obviously moving to Texas. They have been for a while. People are moving to Florida. They have been for a while. But people are moving to places where they want to live and not work, right? Because if you can work from everywhere, you will, right? So this is what happened during COVID. People were living in San Francisco, and then they realized they don't have to go to work. I can live anywhere. So what do? They moved to Lake Tahoe. And they could buy a house. People bought huge houses, overpaid for them, and it shot the prices way up because people could live in a beautiful place and still work. Hell, I wanted to do that too. I just wasn't one of those tech billionaires that could go do that, and plus, it's pretty far from me. Anyway, the point being is a lot of people did that and are still doing it, and people are moving away from certain areas of the country, like California and New York, and they're still moving to places like Texas and Florida. We'll get into why that is later, but let's. Here's another one that I found fascinating as well. This one is the drivers of housing affordability. Now, this is put out by the Federal Reserve of Bank of Atlanta. This isn't some Yahoo doing it. This is actually the Federal Reserve doing it. Now, if you look back, this shows back about, 15 years approximately. And what it shows is here are the contributors to housing prices. So one of the components is income. So how much does income contribute to housing prices? So rising income would lead to higher housing prices. Another one is house price component. So how does the house price lead to affordability? And also the mortgage rate. So if you notice in the last 15 years, excluding prior to COVID, the mortgage rates, or actually 2022, mortgage rates contributed to a more affordable housing price because mortgage rates are really low. Okay. Also, if you look back in certain periods, the housing price component early on led to affordability, but right now there's a huge spike down. So it's highly unaffordable for the housing price component, as meaning the price of the housing, which has gone up significantly. Also, mortgage rate has deeply led to probably in the last 15 years the largest drawdown in affordability for housing. Now, this is what we've been talking about in the show. So I brought this chart on because I wanted to show everybody visually what Jug and I have been talking about for the last 2 years, which is the mortgage rates significantly lead to unaffordability of housing. Now, why haven't housing prices dropped? Well, there's a few other charts we'll show, but basically there's a lot of factors that lead in, and one of them is that there's just fewer houses being sold, fewer people moving, and frankly, there's a lot of people with cash that are just paying cash for houses. So when people have enough money, they don't care. They're just going to do whatever they want to do. There's a house in my street that's getting completely torn down and rebuilt for a brand new house of the same size, which is kind of crazy to me. Usually people upgrade and they build a bigger house so they can sell it for more. These people don't care. They've got plenty of money. They just want the perfect house that also is not a bigger house. It's just a better one than they had. So anyway, people have plenty of money around, and that leads to a housing market that's not declining as much as it should. Plus, people have made more money in the last few years, which leads to a more affordable configuration. Anyway, you should just look at this when you get a chance. It'll kind of show you the trends of real estate. It'll just show you that this is one of the leading dampeners on the affordability of housing. Here's another one I want to show. So this one shows more or less affordability in the housing market. It's just a visual of kind of what we've been talking about. If you look at the lower part of the chart, it's less affordable. Higher part of the chart is more affordable. Obviously, it's really deeply less affordable. This is inventory. The next one, it just shows active inventory for sale. As you can see, pre-COVID, there was a lot of inventory. Post-COVID, it was pretty much 50% less inventory on the market.
Stay on that one for a
Yeah, go
second,
ahead,
Kirk, because
Doug.
that one thing that stood out for me
Yeah.
is I think is obviously if you go back a couple slides and we talk about pricing and and where that's it. So this right here, so house price component, mortgage rate component, income component, a lot of charts here about affordability. If you go down to October 2023, one below that, least affordable month in housing in the century. Okay, now you go back down to that one chart that we were just looking at. Okay, so. And if you take a look here, notice that if we take a look at where 2024 is starting, so what is one of the components of price valuation? Supply versus demand, right? So if we take a look at what was considered on one of those previous charts, some of the most affordable housing that we'd had in history, 2018, 2017, 2019. Look at how much I think maybe it's the chart below that. Go down, scroll down. Yeah. So if you look at more affordable housing market and you look at still being fairly affordable in 2017 to 2018. Now it did dip down a little bit, start to dip down in 2019. But if you go back down to the chart we were just looking at, notice that 2018, 2017, 2019, lots of housing inventory for sale. Now you start looking at 2020, 21, 23. Okay. Not a lot of inventory for sale. So not only do you have higher interest rates, but you don't have a lot of, you have a significantly, in this case, at least looking at, say, 2022, where it ended up, but where it started, less than 50% of the amount of homes that had been available as inventory just 3 years prior. Looking at 2024, it's just starting out, but it's a higher starting point of inventory that we've seen since any time after COVID. Like 2020 inventory was high, then it plummeted. So of course, rising interest rates are a huge component of that because obviously nobody wants to sell their house right now and buy a new house that's going to have a higher interest rate. But starting out 2024, a little higher inventory, we'll see where that trend goes, but it's worth watching because if it's already starting higher, the question is where will it end up as the year goes on? So.
Yeah, and let's kind of keep this part of the conversation going. So this next chart, which I think is really interesting, it just shows the inventory levels compared to pre-pandemic, and it just shows percentage-wise difference. Now, we just went over the numbers, but if you look at the chart from a regionalization perspective, wow, pretty much the whole Northeast is 50% less inventory than before. Pretty much the Midwest, except for the very center line of the country. I'm not sure why that's the case. It's kind of weird, which is more higher inventory, but pretty much everything else.
And what's surprising there is we just talked about how many people were moving to Texas and how much Texas prices have gone up. And yet, look, there's still incredible inventory in Texas.
Yeah, and I think part of it actually leads into one of the other charts we're going to show, which is the home builders, and they're building a lot more houses. Not enough, but they're building more. So if you look at home price levels, this just shows higher level. Obviously, the same thing. House prices look like they're declining in the middle of the country, which may lead to part of that. And then on the coast, it's higher. If you look at this just shows some regionalization inventory levels compared to pre-pandemic. It just shows how that's kind of come about. Some places have more inventory levels, like Austin, New Orleans, but overall in the U.S., it's still a lot less. Yeah, Hartford, there's a lot less. I don't know who's moving to Hartford. I know I'm not. Like that place. I don't know what's. By the way, I went to school in Hartford. I went to college there, and I could tell you. That place that's just got like a big kick me sign on its back. Every time they try to pull themselves out of the rut, just they get kicked back in. When I was there, the Hartford Whalers had left. when the only sports team in the area leaves, that's a bad sign. And then and they're trying to improve it, but every time they do, it just gets sucked back in. They get some nice restaurants, and then there's plenty of money in Connecticut, but just no one stays in Hartford. Like the city shuts down at like 3:00 in the afternoon because there's nothing to do. So they got a lot of work to do, basically. But anyway, the inventory levels have gone down. Obviously, no one's building there for very obvious reasons. The taxes aren't great either. All right, so here's a shift in home prices. Here's let's see, where's the other chart I wanted to show? All right, here's a shift in home prices, basically tracked by Zillow, which isn't always accurate, but let's just, for the sake of argument right now, let's say it is. All right, so this basically what this shows is it shows different housing markets year-over-year change, compared to March of 2020, as well as since the peak of 2022. So if you look at the U.S., 39% housing market went up since 2020. Some areas like Atlanta, Georgia is up 50%. Miami is up 57. Boston's only up 33. I'm actually surprised Boston's up that much, but Dallas, Texas, 41. All the rest are up pretty much in the 30s. California, Riverside's 45. Now, since the peak, San Francisco's down 13.5%. Phoenix is down 9. I think Miami, Florida is up 6 since the peak of 2020, which basically is showing that the real estate peak is 2020. And I'm not sure if that's going to be the case still, but based on statistics, it's showing it is. Dallas, Texas, down 6%. So it's just really interesting to show the different areas and how they're performing. Now, we're not surprised that San Francisco's down. It was already overpriced. But when you look at these different areas, it just shows like where are people moving to? Where are they moving away from? Northeast is pretty blue in terms of people moving towards it, and rightfully so. It's a pretty awesome place. Just saying. Anyway, and then here's another one: U.S. foreclosures by quarter. So, if you look here from pretty much 2003 up until this year, there's 20 years of data, or a little bit more than 20. What you'll see is there's massive foreclosures during the global financial crisis, but actually there's a really low number of foreclosures right now. Now, there could be many reasons for that, but probably because there's a lot of equity built up in those homes. And if you really were desperate enough, you just refi, even though it's a higher rate, you could get away with it. So I think people are a little smarter now. But anyway, point being is foreclosures are really low. Now, foreclosures, that is the last indication that people are stressed. So when you have foreclosures high, and 2008 being a particularly specific period of time when housing was the problem. But if you look at other periods, and I wish they showed back like 50 years, that would be a little bit more telling. But, since we're at the lowest point in the last 20 years, that means that people aren't really distressed. Now, you might have high credit card debt, it is creeping up. And I'll let Doug talk about that a little bit too. But when you have high credit card debt, that's the first sign that people are in trouble, because you're paying 20% to 40% interest rates right now in credit card debt. I mean, I've never had a problem with my credit card. I have really good rates. I have really good credit score. And yet I'm still paying close to 30% on like 2 of my cards for no reason. It's not because of my credit. I've asked them and they're like, no, it's the lowest rate we carry. I'm like, okay, maybe I need a new card. But regardless, the point is that's the first point that people get stressed. This real estate is the last point because it's where you live, right? People do a lot before they foreclose. They'll take out a home equity, they'll refinance, they'll do whatever. They'll sell their house, right? Move into a rental and they'll take their equity. There's a lot of things people can do, but what they won't do, the last thing they'll do is get their house foreclosed on, unless there's withstanding the real estate the global financial crisis. Like I said, that's a unique period, but generally people don't do that. So that's a sign that people aren't totally distressed, but certainly credit cards are showing some signs. I want to share this and I want to let Doug kind of have some 2 cents too. This just shows the percentage share of outstanding mortgages by interest rate. Now, what this shows basically is that between 3 and 4% is close to 45% of the mortgages. 26% of the mortgages are less than 3%. 20% are between 4 and 5%, and then somewhere not quite 10% are between 5 and up. So very small percentage are in the high rates. So if you're buying a new house right now, then you're in the high rates, and you're in less than 4% of the public is in that rate. So people are obviously not buying new homes with mortgages, probably because it's unaffordable. They're paying cash, and people who are doing it are paying a really high rate, and they're doing it because they have to do it for whatever reason. But the point is very small percentage of people are doing that. And there's also a large percentage of the population that owns their houses outright, and those are mostly boomers. So just kind of keep in mind when you're thinking about housing, like we talk about a lot, like housing should go down in value. But the problem is people don't want to move. Obviously, when somewhere in the neighborhood of 80%, 90% of the people, 90% of the people still have low rates because they're not moving. So if they're not moving, then housing prices aren't really accurate. They are in a sense, but I wouldn't call them accurate when people are stuck in their homes and they can't move. They're not selling. You're not really getting a clearing price where people are saying, all right, this is the real rate. Because if I could go out and buy a house that I could afford, well, I need to make twice as much than I made 3 years ago. Well, that's not easy. So that's my marker. I have to make twice as much because that's the housing rates. Because rates have doubled. The rates have gone up so much that my interest payments have doubled for the same house. So anyway, Doug, you want to throw some comments in here too?
Yeah, one of the things I thought was really interesting there's a couple of charts in there that are talking about obviously, it's no brainer about mortgage and purchase applications and refis have completely plummeted. Talking to anybody in the mortgage industry, it's a very quiet time going on right now. But what I thought was really interesting, because you had mentioned the house builders, home builders, and there's some really good charts in here talking about them. Because let's face it, if people are looking at new interest rates and don't want to buy new homes with those interest rates, you would think, even if there's a supply shortage, you'd think that would probably be a challenging situation for these builders. Among the 10 big builders, 9 that actually have profit margins that exceed pre-pandemic levels. Okay, so they're clearly doing very, very well in being able to keep their profit margins high. So they've got a lot of cost to put those homes in the ground, but they're selling them. And they were able to actually absorb the mortgage rate shock. So that we've talked about some things like that, like offer, affordability adjustments, mortgage buy downs, still maintaining elevated profit levels. As a matter of fact, between 2018 and 2023, the profit margin of those 10 builders, most of them, were somewhere around 18 to 19, 20% profit margin, some higher, some lower going into 2018. By 2023, every single one of them is over 20% now, and some of them are approaching 30%. So because that profit margin has been able to be sustained so high, and D.R. Horton, for example, has averaged a quarterly gross margin of 20.82% since 2000. That's including the period between 2007 and 2000 and roughly 2013, in which they were negative. Okay, profit, a decline. I'm sorry, a declining profit margin, not negative. They've not gone negative into any of those periods of time. It's just that's the only period that they were below their average to any significance. All of them have continued to post strong earnings. So because those profit margins into new homes, which is why it's so interesting how much profits built into that. You see people still tearing down homes to build new ones. They have been able to be very creative in their ability to be able to continue to absorb these these shocks to the mortgage interest, and a lot of them a lot of them have actually done their own financing. Now home builder backlogs are actually shrinking as well. So that's starting to show, maybe a little bit of a sign that they're not quite, that there's been some cooling of the purchases. But again, when you're looking at, when you're looking at what's going to go on with the housing industry, and you start seeing profit margins at this level, that does not show a significant sign that the housing industry itself is feeling stress. Okay. People are still buying homes. I was talking to several realtors recently. They're in certain areas, and you go back to that national map again. Where was the red? Where was the blue? There's a lot of the majority of areas of the United States are blue right now, meaning that they are seeing housing prices still go up. They're seeing no recession in terms of home sales, other than that central corridor. And it's getting to the point. A lot of the purchases are cash. Even people coming with cash, The new thing now is no inspection, basically purchasing at sight unseen. So one of the new creative things that they're doing is they're sending inspectors in ahead of time as prospective buyers. Because if you ask for an inspection, they're going to decline you. The seller's going to decline you for someone that is going to be that is going to come in and say, nope, I don't want to see it. I'm going to waive the inspection because I want this home so badly. Well, so what's happening is that there's a trend of sending in inspectors as prospective buyers before the offer to do basically a walkthrough visual inspection, so that at least there's a little bit of information that can be provided to the buyer. Obviously, there's no way to look inside the walls. There's no way to do the depth of due diligence. But when you start seeing this much cutting of corners of what would normally be the due diligence of purchasing in order to be able to try to even compete for the property, even if you're already coming in cash, that means that the people that are coming in with bank lending are not getting much of a chance at all of being able to be successful in these transactions. It tells you that again, we've talked about M2 money supply that's out there. We've talked about all of the money that people have, the cash people have. Listen, this economy is still really, really hot. So yeah, GDP may have just dropped, but you want to know why inflation's still going up? There's a perfect example.
Yeah, we'll talk about some of the next week. We'll talk about some of the overall metrics from the macroeconomic data, which I know is going to put people to sleep, but we're not going to put you to sleep because we're going to make it fun. But there's some interesting data out that shows some of the trends are starting to change. I did want to keep going down this home builder thing because this was so informative on many levels that I wanted to give people an update of different things. Partially because when we talk about things in the show, Doug and I do a lot of research on our own. Like we do our own research, and we always get the question, well, how can, what's the research you look at? Help me figure it out myself. I'm like, honestly, I can't. Like it just takes time. Like you have to come and you have to like basically do your own research, and you have to figure out over time, like what's good and what's not, and what's biased and what's not. And honestly, if I want to know about gold, I'm going to talk to somebody who's biased about gold because they're going to tell me what they think is good or bad, assuming that they're not just, crazy, because there's a lot of crazy gold bugs out there too. But somebody who's really smart, and I know a few people, and I brought them on the show. When they're really smart and they talk about gold, I talk to them, but I don't talk to them all the time because they make me a gold bug too. Just, everything is gold all the time. But when you start to see, like, here's a good example. Here's the 10 largest publicly traded U.S. home builders and the return for the last 1, 2, 3, 4 years. Now, if you look at some of these, they're up like hundreds of percent in the last 4 years. That's crazy. In 3 years even. And there's one of them last year, two of them last year up 100%. So if you're looking at home builders, you're like, wow, why are they up so much when real estate is not? Well, it's in large part because of what we're talking about. And I'm not saying home builders are a good idea now. I'm just saying that this is what's happened and you should be aware of it, right? And because for the last 4 years, people are like, I'm staying away from home builders because, like, hey, housing, it's too expensive. Well, these home builders actually have a lot of land that they're already sitting on and people need to buy and they don't care and they're just buying. And so these home builders aren't necessarily building ultra high-end homes. Like I live in the part of the country where things are expensive, right? You can go to other parts of the country where things are not expensive and they're still building homes and people can still buy them. So apparently their earnings are really good because what they're doing is they're building homes and meeting the inventory needs that the housing market has. So kudos to them for leaning into this. They're doing a great job.
Can I say one quick thing?
Yeah,
This
go
is
ahead.
why you don't short the market, by the way, because
Right.
if a lot of people would have looked at what was going on with rising interest rates and the risk that had to real estate, even stuff that we've been talking about that have been the data on that for a considerable period of time, would have told someone extremely bearish that it would have been a great idea to short these builders. They're going to have some serious headwinds.
Yeah, I
Obviously
mean,
not.
honestly, when it comes to stocks, and that's a great point, Doug. I want to kind of follow up on your point. Is that a lot of people think that they know better than the market and they want to short something. It's usually a bad sign because some of the smartest people out there, when it comes to shorting, will tell you it's the hardest thing to do, and they do it professionally. And they'll tell you that it's really really hard, and don't ever do it because the probability is really low of success. And usually people that are shorting it are usually doing some sort of a pair trade. So like they might um, uh, go long. They might go long Microsoft and short Apple, right? Or go long Exxon and short Chevron, something like that. Like it's a pair trade. So the point of a pair trade is technically it's people call it delta neutral. So if the whole oil sector goes down, then it'll even each other up, right? One goes up, one goes down, and so you're not really losing money. But the idea of a pairs trade is you're offsetting one against the other. So if you're shorting something, you're going long something else. So even if you're wrong, you're probably not severely wrong, right? And that's really what a lot of these people do, and that's what a lot of hedge funds do, and why their risk tends to be lower because they're offsetting each other, so that the sector going down won't destroy them all. Now, something like this, let's lead to the next one, which is housing shortages by research firms. Now, I don't know if you call Fannie Mae a research firm, but anyway, this is the firm's estimate number of housing units that is underbuilt. So if you look at Zonda, which I've never heard of, says there's a million housing market underbuilt, and Fannie Mae says there's 4.4 million underbuilt. Maybe they have a little incentive there. Zillow says something similar. Bank of America, Freddie Mac. You go all the way down, and you get into like Moody's, J.P. Morgan is only 2 million. Anyway, there's obviously a big difference in what the housing shortage is. I think I find this to be very interesting, and I'm curious how they actually come up with their numbers. How do you predict? Oh, this is how many we're short. I think it's mainly just a guess, but anyway, the point being is it's somewhere in the middle. It's probably not 4.4, and it's probably not a million. It's probably somewhere in the middle, like 2.5, or something like that. All right, let's go. Let's pick up something here, and then we can kind of wrap it up here. This may be it.
I want to just talk really quickly about apartments, because I think you just kind of looking at that.
Okay.
One thing, there's a lot of debate that's constantly out there about rent buy, which is cheaper, and we've had a lot of conversations about that. Obviously, people that purchase, you might be locked in at a lower mortgage rate, but then again, or you might be higher depending on where rates are right now. But obviously, you own your place, you control your place, but then there's all the added costs of home ownership that really need to be compounded. Renting has been a significant, it's been a significant challenge for people financially. They've seen rent increases go up significantly over a short period of time. A lot of people talk and complain about it. What's interesting in the data is that we are starting to see that, and I'm trying to find it here, but apartment supply hitting the market in 2024 is set to reach its highest level since 1974. So it's the equilibrium, right? The pendulum. So when there was a shortage of housing, and this is why they say there's a shortage of housing units, it doesn't mean it's a shortage of houses. It just means there's a shortage of places for people to live. So how are they meeting that? Well, they're meeting that because when there's opportunity, when rents are going up, you're going to see investment. And there has been significant investment that has happened to build apartment units. RealPage is forecasting 671,000 apartment units to be completed by 2024. This is the highest amount of supply hitting the market since 1974. So here's one that actually goes back quite a long time, and it's a huge jump from 2023. If we go beyond that, you start looking at new apartment supply by market. Dallas units under construction versus is over two times what was delivered in the last 12 months. Phoenix is maybe 3 times. New York is incredible, 4 times the amount under construction that was there in the last 12 months. What does this mean? Well, it means, and I want to go to the next slide that's on there, is U.S. office department conversion pipeline. Remember, we have a ton of commercial buildings that are out there. And we're seeing, if you really want to watch something, look at the buildings that sold for hundreds of millions of dollars just a couple of years ago. There's transactions for skyscrapers now that are going for like under $10 million for a couple $100 million building. Okay. That's less than the material cost in the building that they're selling for. Well, guess what? If you can't sell it, if nobody's buying it, you start to see the conversion. I saw this after 2007. A lot of offices were being converted into either office condominiums that were purchased by business instead of rent, or they were being turned into residential. And if you look at 2021 to 2024, going from 12,000 office to apartment conversions to 55,000. If you start to see this investment, what's going to happen, or what could happen, and then the next slide talks about different housing markets with the most planned office to apartment conversions. This supply issue could rapidly shift. And I know, and one of the things that's built a lot of wealth out there has been investment in real estate, especially investment in real estate for the purchase of short-term and long-term rentals. If this pendulum is starting to shift a little bit and we start to have a massive supply of rental housing versus purchase housing, there could be a rippling effect of that as well, because all of a sudden that, over the longer term, more supply means a lowering or an easing of rental, which you can charge for rents. And again, if a lot of these owners of these apartments are not just institutions, but individuals, both on the Vrbo or the Airbnb space, but also the long-term rentals, look at possibly an impact of that, of this greater supply of potential apartments triggering, impacting other areas through kind of, again, a trickle down effect. So just something to watch there, because there's a lot of apartments being built. And that could, and the last thing I'll say, that could change a shift between, of course, the cost of owning a home versus renting, which could make renting cheaper and, more affordable than owning.
Yeah. Well, I appreciate the insight. So we're going to wrap it up here in the interest of time here, but but yeah, I thought it was a really good report, and kudos to those guys for putting it together, because Resi Club, like I said, I'm not sure who they are, but it was a good report. So I think it's just illustrative. I wouldn't get caught up in the data so much, but I would just focus on the trends, because I think the trends are important to understand, because some of the things we talk about in the show a lot, really are just simple concepts. Like, the higher mortgage rates means that it's more expensive for you to buy. And what does that lead to? But we also have the other side of it, which we've had a few guests on to talk about this as well, which is the inventory part, which is also a big part of it. And they seem to be counteracting each other. So this is what makes a market, right? No one has all the answers. The price is the final arbiter. And, if you're confused about what's going on, look at the price, because the price should dictate the normal direction for what maybe most normal participants are not seeing, but eventually will see, and then it'll be too late. So just something to keep an eye on. But we're going to wrap it up here, Doug. So final thoughts from you, and where can people find more about you?
Well, a couple thoughts for me. If things are getting tighter and things are getting more expensive, and I've just looked at a bunch of data that was out there right now about the cost of borrowing for college. And again, we're looking at the cost of borrowing for homes. We could talk about that. By the way, one thing I'll say on this, the forecast for the average 30-year fixed mortgage rate, Fannie Mae and Mortgage Bankers Association are both predicting by the end of 2025 that they'll drop by almost 1.5%. Again, opinions are, I don't know. But again, things are more expensive. The cost of borrowing is more expensive, and the same thing for college. And of course, if everything is getting tighter, as it has everywhere else, you cannot go into the last couple of years of raising a child and look at college and then try to make it up as you go. So it creates stress, it creates uncertainty, and ultimately, at the end of the day, it's going to create a poor financial outcome. So get the information you need. Go check out our website. You can reach us at, we actually had to change. We were Pro College Planners. We're changing the name to Mergent College Advisors. You can still get to us through procollegeplanners.com. Go there, get some free information. If you don't have any information to start, then you're going to find out the hard way. And once you stumble into that, it's hard to make plans for a better outcome. So go get some information right now. It's free, and download our free college money report. About 5 minutes, a little bit of information, and get an idea of what the colleges think you're going to have to pay, so you can start being prepared.
Awesome. Well, thanks again for coming on, Doug. And that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth; we make your life better. You can find me. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment to the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, maybe just a licensed financial advisor. I'm one, but I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest